Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're honored to be joined by Bill Nygren, partner, portfolio manager of the Oakmark Fund, the Oakmark Select Fund, and the Oakmark U.S. Large Cap ETF, as well as chief investment officer for U.S. equities at Harris Associates. Bill is widely recognized for his highly successful investment approach, disciplined long-term value investing, and his market expertise. Bill, thank you for joining us today.
Thanks for having me, Gary, and thanks for the very kind introduction.
Sure. Bill, can you share with us how your investment philosophy has evolved over your career and over time?
Well, ever since I first got interested in investing, which for me was back in high school, I was always drawn to a value approach. I was raised in a middle-class family where we were always trying to stretch our budgets. So to me, the idea of buying when things were on sale always resonated. So when I started my career, I would say value investing was much more based on gap statistics than it is today. Stocks that were cheap on price to book or cheap on price to earnings. In fact, before we had the kind of access to data that we had today in the early 80s, at Harris Associates, we'd be so excited the day that our value line screen came in once a month, and it would show what the lowest price stocks were on PE and price to book. But today, as the economy's changed, and it's become much more an information-driven economy, I think the value of intangibles has made gap investing somewhat problematic. When you think of the rules for gap, if you can't touch or feel something and you spend money on it, that expense goes through the income statement. And the idea is you don't really know if it had value or not. So to be conservative, you value it at zero. Today, I think some of the most important spending is on research and development, developing a global infrastructure, customer acquisition costs. And what we do at Harris Oakmark that's different than a lot of traditional value managers is we will take that growth spending that goes through the income statement and we'll put it back on the balance sheet, kind of the same way as if they were building a new plant. And then we'll put it on the balance sheet and depreciate it over time. And we think that better matches the value of that investment with the cost of the investment. And there are a growing number of companies where that's highlighting areas where value creation is not reflected in GAAP accounting.
Right. And what about in managing the portfolio? Some of your portfolios are somewhat concentrated. How do you strike a balance between portfolio concentration and risk management?
I think the first important part of that question is how do you define risk? And a lot of our competitors today think of risk as defined by tracking error. You know, how closely do you mimic the S&P 500? We've got the more like Graham or Buffett thoughts on risk that to us, risk is losing money that you can't readily re-earn. So when we size positions, we try to think about if we're wrong, what's a reasonable loss that we would be taking in that position? And then, to a large extent, our positions are equal weighted around that risk level. So, for example, a company with a more levered balance sheet, we would take a smaller position in because the financial leverage would magnify the range of potential outcomes.
And an issue that all investors face, I think, professional, non-professional, when is it time not to buy the dip and when is it time to double down? What underpins that thought process?
Yeah, I guess the way we think about it at Oakmark is we'll define the dip a little bit differently. And we don't think about dips in stock prices. We think about dips as when companies aren't meeting their fundamental expectations. And if a stock price goes down while the company's meeting fundamental expectations, we're more than happy to add to that position. But we hit the pause button when companies aren't performing fundamentally the way we expect them to. And to us, it's two-sided. It's not just when they underperform, but when they meaningfully outperform our expectations. We think of that, and it's a more pleasant mistake, but it's every bit as much a mistake. So we prize accuracy more than we prize conservatism. But if a company is not meeting the fundamental expectations we had when we purchased it, that's a dip we're not anxious to buy.
The markets continue to be strong this year and have been for a while. Where do you find value today? Are there any sectors or companies today that you think are particularly misunderstood or mispriced by the market? And why do you think that is?
Yeah, I think stepping back, the S&P 500 is at a pretty elevated PE ratio relative to its own history. And a lot of value managers kind of have a knee-jerk reaction to that to say the S&P must be overvalued because the multiple's higher. We look at it a little differently, and we would say the S&P 500 has become the equivalent of a concentrated technology growth fund. And as such, even though the risk level is higher, a PE multiple in the mid-20s is probably a pretty reasonable level. But making a concentrated growth fund the core of your portfolio probably doesn't make much sense. And because of that, we think it's very important that investors look at the other companies that aren't dominating the weightings in the S&P 500. So the Russell Value, for example, of the 1,000 largest companies, it contains 870 of them, the highest number it's ever been. And it's becoming a growthier index than it ever used to be. In a lot of ways, we think that index is a better core for an individual's portfolio today than the S&P 500 is. And the S&P multiple in the mid-20s, the Russell Value somewhere in the mid to upper teens, something like 17 times. But there's still as many S&P 500 companies under 14 times earnings today as there were 5 to 10 years ago when the S&P multiple was more like the Russell multiple is, something like 17, 18 times earnings. And to us, that represents the attractive hunting ground, the stocks that have been kind of left behind in the market for the past 5 to 10 years. And it's an amazingly diversified group. You'll find healthcare companies, all kinds of financial services companies, banks, insurance companies, exchanges, oil companies, media companies. So we think it's a pretty exciting time where we're able to build a diversified portfolio at barely more than half what the S&P 500 multiple is.
Okay, great. You mentioned a hunting ground, looking for stocks. You're allocating capital. But when you look at companies, what signals to you that their capital allocation approach is appropriate or favorable? And can you weigh in on the debate between share repurchases versus increasing dividends?
Our view on capital allocation is pretty straightforward. If a company has investment opportunities where they're competitively advantaged and should be expected to earn an above-average return on capital because of that advantage, and they can increase their organic growth by making those investments, we always favor companies doing that. I think where it becomes problematic is where companies in slower growth businesses decide that they want to try and invest in some higher growth opportunities where they aren't competitively advantaged. And we consider good capital allocation to be make the competitively advantaged investments, and if you don't have those, return the capital to shareholders. Now, other than some slight tax arbitrage, to us, it's not really important whether they return it to us as a dividend or as share repurchase, since every company we own, kind of by the definition of how Oakmark invests, is a company we think is selling below its business value. We're happy to see them return capital via repurchase. And I think the problem with repurchase comes in when you hear management teams say, we did everything else we could think of doing with capital. We had a little left over, so we bought stock back. And they do it because they think it can boost the short-term stock price, as opposed to the stock is priced so attractively it's the best investment they can possibly make.
And within capital allocation, you touched on it a little bit. When you see a company sort of shift how they're allocating capital to themselves, what does that bring to mind on your end? Is that a chance to reassess your investment in that company, or how do you approach that?
Well, I would think of an example like General Motors, which is definitely among the unloved companies today, sells at 5 or 6 times earnings. And they had been going down a path of trying to diversify away from making cars and trucks. whether that was buying Lyft or Cruise or developing their own financial subsidiary. We weren't very happy with the capital allocation they had been showing, and had almost pushed us to the point of exiting the stock. I think some other high-profile investors, perhaps like Berkshire Hathaway, did sell their position partly because of that. But they got a new CFO who came into the company and said their own stock is by far the most attractive investment they could make. And they announced a share repurchase, and it wasn't for just a couple percent of the company, it was for 20%. And it wasn't one time, it was investing that year's excess capital. And they have said if the stock stays this attractive, they'll do it again next year and the year after and the year after. And that to us is a really important mindset change where there's no longer going to be value destruction based on subpar capital allocation.
Okay. Let's shift a little bit to another topic within deciding whether to make an investment or not, corporate governance. Not necessarily an item that shows up in quarterly results, but an important metric to follow. What aspects of corporate governance are most important to you in making an investment? And what do you think the trends are in governance in public companies today in the U.S.?
I think the trends, especially driven by ESG investors, have largely focused on some superficial definitions of diversification at the board level, within management levels. We definitely want diversity of thought on our boards, and that's an important thing for us to see in governance. We kind of think of the board as the unpaid consultants for management, and can they help fill management's knowledge gaps? And a good board can really cover a lot of those bases for a management team. We also want the board to be holding management accountable. We want them to understand that the long-term goal of any company has to be to maximize the value of their underlying stock on a per-share basis. We want them to compensate the management in a way that if management follows their own economic interest, that also is maximizing their personal economics. So we don't like to see incentive plans that are based on just like a gross sales number or income number. We always want a denominator there: sales per share, earnings per share, return on invested capital, metrics that we think help drive per share business value. If you think about the way we like to see capital allocated and share repurchase when that's the best opportunity, a lot of the incentive plans, there's a disincentive to repurchase stock. And if we see that, we'll engage with the management and the board and try and get that corrected. One thing that we do differently than like private equity investors is when we see a company that is not governed the way that we think is in the shareholders' interest, we don't fight that. We just move on and go to a different investment. So we're always trying to align with the companies that are governed effectively in a way that the goal is maximizing long-term business value.
And within that insider ownership or insider buying, does that create a trigger for you or make it more interesting, or is that just part of the whole picture?
Well, it's definitely part of the whole picture, but it's a nice piece to the mosaic. Kind of in the same way that our shareholders expect us as portfolio managers to be invested in our own funds, which we definitely are in Oakmark. In fact, the reason we started our funds was because we wanted to invest our own capital that way. We expect companies to do the same thing. If a CEO of a large company thinks other companies are better investment opportunities than their own, there's something wrong with that picture.
Right. Shifting to the macro a bit, a lot of headlines out there that are driving the market. Inflation has been a buzzword for a while in investing. Do you think that there's some degree of it that's a structural issue, or is this purely a cyclical challenge that eventually will normalize further?
I guess I would say I think there is structural inflation at something like the Fed targets of 2 to 3% per year. There are just too many constituencies that benefit from a small level of inflation. So many wages are tied directly to inflation. The government has obviously a lot of debt outstanding, and inflation helps to decrease the value of that outstanding debt. Now, clearly, we had inflation well above that level that was a cyclic issue, but I think 2 to 3% inflation is a very manageable number. I think that's a good environment for equity investors, and I don't see anything problematic with it.
Some of the other items on the list, employment, tariffs, geopolitical tensions, all potential headline risks. How do you rank these, and what's your advice to investors managing a portfolio for factoring this into their investing approach?
So we've looked back over like a 30-year time period. Oakmark Fund has been around for 35 years. And I think the number is if you put $10,000 into the S&P 500 35 years ago, you have something over 300,000 today, 30 times. I think it's ironic given underlying trends that are so strong for equities that investors spend so much time analyzing current events, trying to decide if now might be the right moment to be out of the market for a little while. Something we did in a quarterly report several years ago was we went back to the year Oakmark started, 1991, and listed what the major negative macro issue was in each year since Oakmark started. It's an intimidating list. And today's issues of divided politics and tariffs, inflation coming down, maybe interest rates being too high, I mean, it doesn't look that intimidating when you look at the list that we've had the past 35 years and then realize the market's up 30-fold over that time period.
Any other catalysts you'd highlight, potential triggers for a correction or upside surprises that you think aren't fully appreciated by investors today?
We aren't arguing that the market's overvalued today, so we kind of think that the chance of down 10% or up 10% from here is equally likely. I would say I think one of the things investors should really focus on is this issue of risk inside of the S&P 500. We've never seen the top 5 or top 7 names as much a percent of the market as they are. We've never seen the top 10 to have 9 be effectively in the same industry. It has been a very long time, like well over 30 years, since we've seen the S&P 500 a more volatile index than the average mutual fund is. And I think investors have just kind of gotten so used to the idea that the safest way to invest in the market is the S&P 500 that like there's such cognitive dissonance when you say the S&P has really become a risky index, unlike what it was 10 years ago, that people don't know how to react to that. And I think investors really should be revisiting their portfolios if they are S&P-centric portfolios, because they've become a lot riskier than they used to be. Not necessarily overvalued, but if somebody came to a financial advisor and said, I have almost all my assets in one fund where the largest name is over 7%, the top 10 positions are 40%, they're almost all in the same industry, I think a prudent financial advisor would say, you've really got to take a step back here and revisit that. But because that index is called the S&P 500, those conversations aren't happening.
And you alluded to it, technology. Technology has had a big impact on the markets in this move up. AI has dominated headlines. Do you see AI as an investable theme at this point, and how much? And do you also see AI changing the practice of investment management at some point?
Yeah, a lot in those questions. First, I would say I've been at this long enough that AI is really the third technological transformation I've seen, with the first one being in the 80s of computerization and the second one being the move to the internet around 2000. And the pattern is interesting to me that Wall Street always gets excited about the arms providers. And if you look at the past two, that wasn't the right way to invest. In fact, it became disastrous. But the companies that really benefited were those that utilized the technology and they used that to grow their moat in their basic businesses. I mean, think about when computers came in Sears and Kmart were two of the largest retailers, and they were two of the slowest to adopt computerization of their inventory, their reorder system, collecting data from customers as they checked out. And who was best at it was Walmart. And it allowed them to gain tremendous share. You think about 2000, Cisco was one of the largest companies in market cap, and investors correctly anticipated that there would be tremendous growth in demand for Cisco's product. But what they got wrong was that each generation did like 5 times more processing than the earlier ones did and cost half as much. Cisco was able to maintain a dominant market share, but because their performance pricing characteristics got so much better, it was not a good investment. And who benefited from the internet? It wasn't Cisco and AOL. It was the companies that used it in retailing, Amazon, in social media, Meta, in search, Alphabet. If you think about that analogy rolling forward today, it makes us a little bit cautious when people talk about NVIDIA having long-term monopoly-like power in this market, and has us instead looking at who might benefit from using AI in their business. And companies that we own like Charter Communications have used it to dramatically cut cost and improve quality of customer service. Capital One in the credit card business, they're utilizing it to make faster decisions, almost instantaneous decisions on whether or not you're approved for your credit card. I think it's that kind of usage where it's not implied in the stock prices at all. Both those companies are around 10 times earnings or less, where if they can grow their competitive advantage by using AI faster and better than their competitors do, that it could be very important for them.
What about the investment management business? I mean, what do you think? What kind of impact will it have on that potentially? And what do you think the investment management business could look like 5 to 10 years out?
Well, there are a couple things that we're using it for at Harris Oakmark. One, we've done a really good job over the past 15 years of saving our data at the time we made recommendations for a new stock purchase, and then how that recommendation evolved over time. We're using AI to analyze our own data to see if there's a trend in the errors that we make on our new investment ideas. Too early to tell yet how successful that's going to be, but it's a process that we used to do manually, and this will clearly save a lot of time. And another is an area that seems really simple, but like I write a quarterly commentary. It's about 1,500 words or so on average. My process for writing is I write it about twice that long, and that part takes maybe 20% of the time. 80% of the time is editing that down to what I want to ultimately publish. I can put that into AI now and say, using Bill Nygren's voice, can you cut this in half? And it's not 100% there, but probably takes something that I was spending 80% of my time on and cuts it down to 20%. So I think in the way we communicate with each other, it's going to improve the quality and reduce the time that we spend on it.
Back in the investing world, innovation is also prevalent. Crypto in the capital markets. What's your take on the role of crypto today?
It's something we don't have an opinion on. Kind of a funny story. I was on a panel a couple of years ago, and we were asked what our investment position was in crypto. And I said, we have absolutely no idea what it's worth. And because of that, we don't own it. And the guy following me said, completely agree with what Bill said on having no idea what it's worth. That's why it's 5% of all of our clients' portfolios.
Yeah.
It could be anything from a pet rock to worth multiples of what today's value is. We have no idea. And I think one of the things we've been really good about at Harris Oakmark is if we don't think we have a reason to better understand an investment than our competitors do, we won't make it.
Bill, you've given us a great framework for how to think about investing. For all us non-professional investors, can you share with us How do you know when to maintain conviction in investment and when markets are moving, particularly when markets are moving against you?
Well, first, we don't worry too much about where the market is going. And even on an individual investment, we aren't that concerned if the stock is up or down in the short term. When we buy a company, it's because we think it's selling at a meaningful discount to what we think it'll be worth 5 to 7 years from now. What we're focused on instead is what are the main points of the thesis we had when we bought it? What were we thinking differently about than other investors were? And then how does that roadmap look? People often say about value investors that if you're patient, you will ultimately be right. But that's only true if your analysis was also right. So we rigorously track how the fundamentals are performing relative to what our expectations were. And we start to worry not when the stock price is up or down too much, but when there's a wide deviation between our expected fundamental results and the actual fundamentals. And that will trigger us to have incremental meetings with the management, maybe switch analysts on the stock, but really try to revisit, if we didn't own this today, would we buy it? And I think one of the mistakes investors often make is they feel like they don't know enough to sell. And the default becomes, if I don't know enough, I'm going to keep it in the portfolio. We've tried to do that differently and say, if we didn't know enough to buy this as a new position, then we don't know enough to hold it. And sell becomes our default if we don't have the conviction to say we would have bought it today.
Bill, thank you for sharing your time and insights with us today. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon.